Welcome, everyone. My name is Holger Wietz, and I'm the General Manager Projects, Financial and Commercial at the Global CCS Institute. I'm your Master of Ceremony for this webinar, and I just want to cover a little bit of housekeeping quickly before we start. Questions are welcome during the webinar, so please submit them whenever you like using the question panel on your GoToWebinar interface. We will select some questions for posing to Allan. You will have the option of asking him yourself via your computer's microphone, or we can ask it on your behalf. If you can't get through all the questions, then we'll still post them to Allan at a later date and circulate the responses. The webinar will be recorded and available on your website, on our website, in the next few days, and we will email you when it is available for your download. Let me now introduce our today's presenter. It is Allan Baker. He is Managing Director and Global Head of Power at Société Générale. He is involved in the power sector for more than 25 years. He has advised on a wide variety of financing power projects around the world. He is also leading the bank's strategy for structured finance in the power sector and developing in particular CCS as a potential business line for the bank. He has advised on projects in the Middle East as well as in the UK. He has a Bachelor of Science in Mechanical Engineering, and he is also an MBA. Today's webinar will follow the topic Financing the Future of CCS. It's quite important to understand the role that financing plays for CCS in future. It's quite important to add a finances perspective to the discussion. Until today, we have not seen project financing for a CCS project in the world. However, we recognize a strong interest also by banks to deal stronger with CCS and the aspects of CCS. We see, for example, interest to include CCS ready in sustainability programs and criteria. And today, we would like to go some further steps together with Allan. You can add your questions to the discussion and raise in particular points that are of interest to you to the following slides that Allan is presenting to you. Allan, thank you very much for being with us today, and now the virtual floor is open to you.
Sorry, let me just minimize.
Sorry, what's what?
Sorry. Thank you very much, and I'd like to welcome you to this webinar on the financing prospects for CCS. SocGen has a very long-standing presence in the financing of the energy sector, and specifically we've been financing power projects around the world for many years. So CCS seemed to us to be a natural extension of this business. We've been involved in CCS for more than 4 years as an institution. It's been something of a lonely furrow sometimes. There have been very few financial institutions who've really focused on the business so far. But we see it as an area that's got a potentially significant contribution to make to the decarbonisation of the power sector, and something which is particularly important for the power business going forwards, hence our interest in this. The bank's advised on CCS projects so far in the US, in the Middle East, in Europe, including the Masdar CCS full chain project in Abu Dhabi and the Don Valley, formerly Powerfuel project in the UK. So we feel we've contributed to the debate in many ways up to now. Based on this experience, we think we've positioned ourselves as a leading financial institution in the sector, and one of the only institutions, I think, that has gone through a lot of the thought process on the detailed issues of integrating CCS into the power sector. However, when we discuss CCS with other financial institutions, the usual question to me is, why are you bothering? Nothing's going to happen for years in this sector. And that really is the crux of the matter and the main issue I'd like to talk about today on this webinar. This is a disclaimer which I'm obliged to show at the beginning, which says that we'll be not responsible for anything we say, but essentially it means that this is based on public information. And moving on to the presentation. As I said, we believe CCS could become a very attractive potential market for banks. It's an essential part, as I said, of the need to decarbonise power in going forward. It enables, importantly, the continued use of coal, which is one of the most abundant fuel sources, fossil fuel sources, by removing the CO2 from that and putting it on a much lower CO2 intensity than otherwise it would be. It doesn't suffer from, a plant fitted with CCS wouldn't suffer from the intermittency that we see with the wind and solar projects that we're financing, so it has benefit in terms of its reliability and its ability to operate in base load and also to balance the unreliable capacity. And most importantly of all, I think it's applicable to existing as well as new fossil fuel generation. Clearly there's a huge amount of existing capacity out there with a long economic life left, and CCS is one way to use that capacity and extend the life of that capacity in an environment where environmental emissions legislation is constraining more and more fossil fuel plants. One key aspect of CCS that we've noted, and part of the rationale for us to focus on particular areas and particular projects, has been the importance of geography. Clearly, it helps in terms of economics for CCS if there are clusters of emitters that you can gather CO2 from. It improves the economics significantly if you can do that. And storage sites and the opportunity for storage is absolutely crucial, as people will be aware. And clearly there are many storage opportunities in saline aquifers, depleted oil and gas fields. But as we've seen recently, I think from a number of projects, the issues for onshore storage are much more significant in terms of public acceptance than they are for offshore storage. So a lot of the projects that we see moving ahead are based around offshore storage initially. Most importantly for lenders, I think, as well, and something which should really attract lenders to this sector, is scale. If you look at the investment forecast from IEA, published in their roadmap document some time ago, the investment required in low carbon technology is huge. And certainly it's an area where it's not going to be financed just by equity. There needs to be the contribution of the debt markets in this to leverage people's equity to build out the industry. So a significant part of the future energy landscape, I think, for lenders to the power sector at the moment is going to be focused on the rollout of CCS, and timing, I think, is an issue. And I think the conclusion that we came to was that if proven and implemented properly, CCS can make a major and cost-effective contribution to decarbonisation. Attracting lenders to a sector is easy in principle. You just need to check the number of boxes that they will focus on as they go through their analysis. The first is strong market fundamentals, a clear public financing and regulatory framework, strong project economics, proven technology and low execution risk, and favourable market conditions. The unfortunate thing for CCS at the moment, in the mind of many lenders, and certainly we have concerns here as well, is that it doesn't really check any of these boxes at the moment. Digging a little deeper into each of these points to see where the industry is at the moment. I've chosen on this slide the UK as an example in terms of the graph on the right to show that whilst there is a strong demand for CCS going forward in the electricity mix, it's not predicted to, certainly in the case of the UK anyway, not predicted to make a major impact until 2020 and not become a significant contributor to carbon reduction until maybe 2030, 2040. One of the issues with this is that for although the plans for CCS are substantial, the investment funds are huge, most bankers find it difficult to look 5 years ahead, let alone out to 2020, 25. So their perspective at the moment is that they don't need to do anything, they don't need to really understand CCS or get involved in the sector because it's a long way in the future and there's plenty of time for them to pick it up when the industry becomes more developed. So yeah, if you add to this the clarification required around the new market frameworks that are being put in place for this, and the UK is an example of that, where they're implementing a feed-in tariff structure based on the contract for difference. It's even more reason why the enthusiasm of lenders wanes in this area, because having regulatory uncertainty, having the lack of a framework to support the development of CCS just makes them even more skeptical about the financing prospects. And then just to finish the picture, we have a situation where when project financiers look at the risk allocation of this, and they're specialists at risk allocation, CCS highlights CCS has some risks which they find very difficult to accept from a debt perspective. In fact, the equities find it very difficult to accept some of these risks, which I'll touch on later. So the banks are looking at this and waiting for somebody to resolve the allocation of those risks, and essentially waiting for maybe government to pick up some of the risks that neither equity or debt are willing to take. So the key to moving forward in terms of the market fundamentals, I think, is putting in place a transparent regulatory environment and reaching a risk allocation and regulatory framework which gives people the confidence to put their money into this. But one other point I've raised at this stage is that there's been a lot of coverage, and I think in the recent report from the global CCSI, it highlighted this as well, that CCS is relatively expensive as of today. It's a development. We're in the development stage, so the technology is being tested. By definition, that's going to be relatively expensive. People are looking for the nth-of-a-kind cost trajectory for CCS to believe that in the longer term it's going to become comparable with other low-carbon generation. And it's the same approach that's been taken by lenders and by equity in the solar space, for example, where you can see that there are large cost savings with the economies of scale with technological developments. So the industry needs to demonstrate, firstly, that they understand the cost base, and secondly, that the trajectory of those costs is down. And one of the major contributors to that is obviously the parasitic load of the plants. So that's something which people are really focused on at the moment in terms of whether this is a long-term industry. Looking at key public financing and regulatory issues, the global CCSI status report is now available on the website, and this paints, for me, an interesting picture of the 77 projects. Of the 77 projects being monitored or listed at the moment, from the previous report, 3 have been cancelled, 8 are on hold, and 8 have been added. And as well, interestingly, only 8 of these are in the execution phase, with 52 in evaluation and define. In essence, my reading of that is that it implies that there are a lot of projects in the departure lounge waiting for the right conditions for takeoff, but those conditions are not there at the moment. People are struggling to bring those projects to fruition. We're seeing attrition along the way, even if new projects are being added. It's also worth noting that whilst there are projects in operation, very few of these are fitted into power plants or in the power sector. And those that are, the few examples are only capturing relatively small proportions of the CO2 being emitted. In effect, they're test plants trying to prove the underlying technology. Whilst progress is being made on policy and incentive regimes for CCS, it still appears to us to be relatively ill-defined. There are clearly good examples of strategies to bring forward CCS, and I'd say that the UK government policy with the contract for difference is one of those, although that still remains to be fully defined as well. But we are seeing a lot of funding being made available through, for example, the NER 300 program in Europe to try and at least get through the demonstration phase, but it's actually quite difficult to access that funding to agree the terms under which that funding will be provided. And in order for those projects to work, we still need the underlying support of the regulatory and incentive framework. So where does that leave us? I think CCS, it leaves us anyway asking as lenders, I think the lending community asking whether CCS is a business or an interesting experiment. Clearly, most of the projects are referred to as demonstration phase projects, which implies that they're still in the research and development phase. And research and development is not really an area where the project lending community or project finance community is actually that comfortable. So there's still a question mark over whether this is a real business or whether it will develop into a real business. On the project economics, we always come back to project economics. We have a number of issues here. The first, I think, is the lack of drivers, lack of clarity on the key drivers of the CCS business. The sources of revenue are uncertain. On a power station, we understand what the revenue is. You look to the electricity market for the product you sell. Here, we're faced with a number of other potential sources of revenue, ranging from grant money, CO2 certificates in the European Trading Scheme, other incentives. But with the incentives, there's a risk that we're going to see also a capped return, but no downside protection with these projects. So in other words, if you're on a contract for difference, for example, as the UK government are proposing, your upside is essentially capped by the strike price on the contract. But there is a risk of downside if the plant doesn't work properly or is not operating properly. So the revenue risk on the CCS plant is substantial. There is a positive kicker from enhanced oil recovery to the extent that it's part of the project, or that the CCS project can sell CO2 to an oil field or an oil field operator. But again, the economics of enhanced oil recovery outside of the US, to my mind, still have to be proven. There's a debate about what value CO2 has to an oil field operator, whether they should be paid for taking the CO2, doing service to the environment, or whether they should pay for CO2. And we've seen that debate on a number of projects, and it's quite difficult to reach a resolution on that. The cost structure is also uncertain. But clearly, these are viewed by the lending community as a first of a kind or a scale-up industry, and that can often be associated with delay and cost overrun. And we've seen in other areas of the industry that inevitably that is the case, and that's not a risk that lenders are too comfortable in taking. And again, is a significant risk if you go back to a situation where you're effectively receiving a fixed incentive. It may not cover your capital costs in the end or erode your return if there are significant cost overruns on construction, but also on the operating cost. There's competition as well for CCS. It's not the only low carbon technology. We can compare it with nuclear, we can compare it with offshore wind, and despite having advantages of, or not having the disadvantage of intermittency, there is still a cost comparison I think that's going to be made between different forms of low carbon generation. And this leads on to the next point, whether governments and consumers can afford CCS or more widely afford low carbon generation. There's a real risk in my mind that given the current economic climate, the government funding for demonstration phase projects could dry up or could be deferred significantly while they focus on other areas. But either way, the consumer is going to pay the bill, and affordability will become a major issue in the future, and there'll be more public comparison, I think, of the cost, or the cost of different green generation technologies and the cost of decarbonisation as a whole. Technology risk is another hotspot for lenders when they do their analysis of transactions or opportunities. New technologies are always going to be an issue, and CCS has has a significant share of these challenges at the moment. It's clear that most of the process involved in CCS are proven in our view. We see them operating in other industries in different contexts. But the issue for me really on this area is the scale-up and the integration risk. Scale-up because we haven't got demonstration plants of the industrial full-scale size to use as benchmarks, and there are very few examples of the integration of carbon capture within a power station type environment where you've got an emitter which is facing a market and trying to compete in the market, being asked to commit to capture carbon, which could constrain or impact on their ability to function in the market. There are examples of CO2 capture in a sense, but they weren't designed as CCS projects. And SocGen and a number of other banks have financed 3 or 4 IGCC plants in Italy, which were a full-scale deployment of gasification, but they weren't designed to be carbon capture, even if they were integrated with power station operations. So the integration side was tested there and proved to actually bring some significant problems. The second area is storage. Clearly, again, we can see examples of CO2, natural CO2, being used for enhanced oil recovery in the US and in other places. There have been demonstrations or there are ongoing injections of CO2 in saline aquifers and depleted reservoirs and other formations, but again, not at the scale envisaged by the growth forecast for the CCS industry. And again, it's scalability, which is our concern here. And whether it's for EOR or not, CO2 is essentially a liability if it's removed for the purposes of sequestration. This has not been the case in most EOR to date, which has been based on natural rather than anthropometric CO2. CO2 is just a tool in that sense to remove additional oil from the ground. We're now having to focus on the long-term storage and long-term security of the CO2 in the ground. And lenders and the insurance industry indeed have been somewhat reluctant to take that long-term risk, particularly without a matched long-term revenue. As I said, you have effectively a liability in the ground, whereas oil obviously in enhanced oil recovery is an asset. So we have a long-term liability without necessarily long-term revenue to cover that risk. The project-on-project risk is a much used term, and we've focused on this in a number of the transactions where we've been advising, but it's probably one of the key risks in commercialization of the industry. The complexity and potential risks of linking capture, transport and storage to a commercial power plant really can't be underestimated. And for a lender, this is only adding further uncertainties around CCS and further complication to what is already a complex area of financing generation capacity in competitive markets. So banks are concerned about technology, and the real concern here is that the demonstration plants never really work properly properly or indeed don't work at all. And a project finance in that circumstance may be essentially a white elephant. So we're certainly working with governments, regulators and other people around the world to try and work out how we can finance, but past that delivery risk, if you like, on the technology off to another party who's more able to take that risk. This diagram is, the detail is not really important. I've put it in here just to demonstrate the previous points on integration. Really, CCS should be a very simple business. You catch it, you ship it, and you store it. But when you come to actually overlay the commercial structure onto these situations, as we have, again, for a number of the projects where we're advising, it actually becomes significantly more complex. And these are just some examples of the commercial structures we've been talking to people about and where the lenders fit in. So the addition of these boxes, is just to illustrate the commercial complexity, and this is on top of an already complex power plant where you may have a whole suite of agreements based on availability of the plant and reliability selling into the market. Really, when you look at this diagram, the transporter just really wants to ship without taking any liability for the CO2. The EOR player on the other end just wants CO2 delivered when he wants it, with no exposure to the capture or the transport end of the chain, the parts of the chain. But the complexity multiplies even further when you get multiple emitters, which we're seeing in a number of schemes, particularly where you look at hubs, emission hubs, different owners for different parts of the chain. It's conceivable that you won't have a single entity owning this chain because they're very different businesses, from capture through to pipeline through to the injection and the end use. And then the next level of complexity when you start looking at third-party access rights to shared infrastructure and how you share the liabilities, the cost, and the other issues associated with that. So the bottom line is that the integration components add massively to the complexity of their projects and would be, in many ways, an unwelcome burden on top of an already complex financing situation for many lenders. And the integration of the plant requires skills outside of the domain of a lot of the traditional power developers as well. So that's an additional risk in trying to integrate the construction and the operation of each part of the chain into the power project. It may be the original target of the financing. The final element that I'd like to just touch on is, given the press coverage recently and over the last 18 months or so, it's absolutely clear that current market conditions in terms of financing are not really favouring CCS financing at the moment. And I think it's fortunate in the sense that we haven't yet reached a position where there are a number of projects looking to raise finance, because even the most traditional projects in the power sector are finding it difficult to raise that money at the moment. The first issue really to focus on is market liquidity, and there are still significant issues in market liquidity. So in a storm, people head for a safe harbour, and this means that where there is capital, it's being focused on core clients and on standard projects that people have a good track record of, that people understand, people know well. And we're seeing an example of this in the offshore wind business, where deals are getting financed, and offshore wind is analogous in a way to CCS in that it's slightly further ahead down the development curve, but there are still issues there. But it's being financed by a relatively small group of banks who've taken the time to understand the business and over the last 3 to 4 years get comfortable with many of the risks. And that's a challenge I think that the CCS industry has to go through now, is to engage with the finance community, to educate them about the industry, the risks, and try and come up with structures as they have in offshore wind, including government incentive and risk mitigation, which enables CCS to get built. As I said, the risk appetite, I think, in difficult times of banks also narrows. So, a banker is always said to be someone who will lend you an umbrella on a sunny day, and that's very much the situation at the moment. That lenders are focusing on projects they understand, on technology they understand, on technology they're comfortable with. The second most common sentiment I hear from colleagues in banking and the finance community after after why bother is really, why should we take this risk? And their cursory risk analysis has led them to believe that there are a number of risks here which they would never get their credit committees comfortable with. So until we deal with those risks and allocate those risks to appropriate people, it's why should we take that risk is going to be their attitude, and they're not particularly interested. That issue, in my view, could slow down the development of CCS ultimately if it's going to be built out at scale, because it's not going to be built on just equity. It's going to require significant amounts of debt financing as well. And ignorance is sometimes bliss, but I think in the case of the CCS industry, many of the banks are just not aware of CCS, what it means for them, where the industry is going, the potential scale of the industry. They just haven't picked up on that. They haven't really focused on it as a potential opportunity yet. So they're not even part of the debate. I go to many meetings with governments and other people to talk about the issues we see with financing the industry, but they find it actually very difficult to engage with the finance community, to get people to actually go along and discuss with them the issues of financing, the issues that are blocking financing. So again, engagement, communication, I think is very important. And then the vision, what are lenders being asked to finance? You can look at the IEA forecast, you can look at the UK government, you can look at DOE in the US, their ambitions for CCS. But we don't see any defined targets, as we've seen, for example, for wind development or solar development in many markets. We see a demonstration phase, or a demonstration of the technology, a demonstration of the storage, a demonstration of the commercial structures that are going to be put in place. And that sounds much more like an R&D type stage industry than an industry which is expected to take off in a very big way. And again, the project finance industry isn't comfortable with financing research and development. And there's an issue of approach in the industry as well, to a certain extent. I mean, one of my clients memorably said at a meeting that he thought the industry should change its focus and start planning for success rather than planning for failure. And I think that's something of an unwarranted criticism, because there's a lot of enthusiasm, a lot of commitment to making this happen. But certainly, if people are talking about demonstration projects as demonstrating technology that may or may not work, or may or may not work at the level it's expected to, then it's not going to be easy to engage with the financing community. So just to wrap up with some conclusions, I think building confidence is very important in the industry, but building knowledge is almost as important at the moment. It's never too early to engage with the finance community, or they really won't be there when the debt is actually needed, and whether that's in 2 years, 5 years, when the first big demand for project financing in one of these transactions comes. If the institutions haven't at least raised the industry, or raised CCS internally, haven't done a lot of the research they need to do, it will take them another 18 months or 2 years before they're really in a position to do the financing. And that's certainly, again, something we saw in the offshore wind, and we're seeing it at the moment in the utility scale solar. The preparation is clearly important. There is the engagement, I think, between all at least the stakeholders are working together, and there's a lot more through the global CCSI and other institutions. There's a lot more exchange of information, which is improving the visibility of the industry. But I still think that lenders are not yet on that train. They're not part of that process. And Société is trying very hard to stimulate that engagement, even though some could say it's creating more competition for us, certainly in advisory. But we do have a vested interest in seeing other banks get into this business as well, because we're not going to finance alone in this. We need other banks to come alongside with us. And it's not just in terms of how we proceed. We're not looking necessarily just for direct financial support in the form of grants and subsidies for the industry. I think, again, almost more importantly, is is the willingness of governments and other institutions to underwrite some of the risks which debt and even equity are not willing to take at this stage. If you want to move from demonstration to implementation, you need to get the demonstration projects done. So that requires a pragmatic view that somebody may need to take more risk than they're comfortable with, or provide more of a guarantee or more underwriting of that risk than they're comfortable with at the beginning of the process to get through to the implementation stage. And many of the debates we're having at the moment with, again, governments and regulators, it's centered around why they're not prepared to take that risk, or why their Treasury or Department of Energy is not prepared to take that risk, rather than saying this is a risk we need to take to move forward. And there are examples where governments in Australia, for example, and other areas where people are being more pragmatic, in Canada taking that risk, and in the interest of moving the industry forward. But there's obviously more incentive to do that in a country that has an abundant source of coal, that sees coal generation as a very important part of the mix going forward than there is in a more gas-dominated or more renewable-dominated country. And that's, I think, why we're seeing some countries moving ahead faster than others at the moment. It's also sometimes overlooked, I think, and my last point here on the conclusion is that lenders have choice and their flexibility. We run I run a global power team. We can put money geographically where we think we're going to get the best return for the least risk, and in sectors where we believe we're going to get the best return for the appropriate risk. So CCS is competing for that capital with offshore wind, with nuclear, with other areas of the power business, even generating, gas-fired generating, for example. So the industry needs to be made attractive, it needs to be made competitive, and it needs to be in a form which is going to attract that capital and make people willing to put that capital at risk, whether it's in terms of debt or in terms of equity. That's the end of what I wanted to say. I'm happy to take any questions and answer as many as I can.
Yeah, thank you, Alan. Thank you very much. That was a quite insightful and informative overview and perspective from the financing standpoint. Just to comment on some of your points, as you rightly pointed out, the most critical sector is definitely the power generation sector. And from our this year's survey, the Global CCS Institute can certainly report that among the 14 projects that are currently under operation or under construction, we now see 2 projects coming from the power generation sector. And possibly my opening question in that respect would be, are there any completely new structural features coming along with CCS power generation projects to be financed? Is there anything really there that has not been included in financing structures in other projects, being it nuclear, renewable, or even in other industries? Are there really completely new financing structures required for CCS power generation projects?
I actually don't think so. I think we, as an institution, we finance pipelines, we finance projects that are based around enhanced oil recovery, we finance power stations, we finance process plants. I think the issue here is the integration and financing either the whole, which I suspect is going to be unlikely. I suspect these projects are going to be broken down into segments where different people take equity in different pieces of the project. But it's the integration, it's the commercial aspects of not, if you're an enhanced oil recovery player, as I said, you just want the CO2. So if the CO2 doesn't arrive, you're penalising the transportation companies that are providing the pipeline, you're penalising the CCS plants, and then how do we deal at the generation end with that potential penalty? So it's more the commercial integration of the industry and moving
understand that, and maybe a additional question on that. It seems to be it is more a question of knowledge and managing of risks, understanding how to manage those risks to really engage the financial community stronger in CCS projects. Can you elaborate a bit more on how many demonstration plans you would think are necessary to increase the willingness and also the appetite to invest also into CCS projects?
If I look at other areas of the business where we've financed early stage opportunities, going back many years to the gasifiers in Italy, the IGCC projects, when we were working on the structuring of the first one of those projects, the lenders or the lending community had many issues with the risk, with the technology, with the integration, with the operation, the cost structure and so forth. The first deal was very strongly structured to mitigate many of those risks, but once that deal was closed and in construction, once the plants start operating and people can see an operating plant, then there's a sort of multiplication effect in terms of the number of institutions willing to look at it. And we're seeing the same thing at the moment in offshore wind, where two years ago, even maybe three years ago, there were a handful of banks interested in financing offshore wind. No one interested in financing construction risk in offshore wind. With the development of a number of projects, with the feedback and information from those projects, the lenders have actually financed on very conservative terms. We're now seeing the number of banks interested increasing, but also the willingness to take risk increasing, so that the deals that have closed more recently, banks have taken an element of construction risk within their structure which they were unprepared to take even 12 months ago. So it doesn't take very much in terms of operation or demonstration to start to get banks comfortable that it's a sector they can finance. So one of the key risks here, I think, and one of the risks that is often thrown at me by other lenders, is the concern that the plant just won't operate or just won't work. So what are you left with? If it's a large-scale plant, you might be left with 1.5 billion, 2 billion worth of chemical processing plants, which is useless, it's worthless, and the power plant, which doesn't meet the emissions requirements or has to go into the market and buy CO2. Now that's not a risk. I think we don't see that kind of Armageddon risk. We see more a performance-related risk where maybe the plant doesn't capture quite as much CO2 as it should, but nonetheless that's still a significant financial risk.
Okay, at this point I can refer to one of the questions that we have received, and it is from Cheryl Wilson, and she would like to know how important would you regard an insurance for a power project? Would a bank need a full system warranty on a power plant with CCS, meaning for its reliability, its output, to offer finance?
I think in terms of the power station itself, we wouldn't envisage any additional insurance. We already insure against business interruption. Typically, we already a mechanical breakdown, those kind of issues. So the reliability side of the plant, the insurance issues relate to, again, back to the commercial structure. So to the extent that an outage, for example, at the power plant would mean that we were penalised somewhere further down the line by an off-taker of CO2 or a pipeline company, then the cost of that has to then be factored into the insurance. So I don't think the insurance itself changes. What will change is probably the extent of the liability that is being insured. The other area where we're clearly looking to the insurance industry to pick up a risk is on the storage end of the equation. To the extent banks are being asked to finance storage, then the insurance of the liability of leakage it's something which we're in a discussion with the insurance industry on. And there, clearly, if it's within the European Commission or the European Union, you will be penalised for leakage by having to go into the market and buy CO2 certificates. If you're a storage operator, a pure storage operator, you have no revenue to cover the purchase of those certificates. But it's something of an unquantifiable, to my mind, again, a fairly small risk, but it's an unquantifiable liability. And that's where maybe we're looking, and the insurance industry, I'm sure, are looking for some form of government underpinning of that risk.
Maybe again, possibly a good point to raise another question, and that has been keyed in by Eric Bainan. He would like to know whether the financial community can contribute with possibly new innovative financial approaches to help advance CCS and to get it off the ground and overcome the initial early mover challenges.
Again, to a certain extent, and I would say that project finance is one of the most innovative areas of the industry. I mean, we came up with structures originally to finance the IPP business, even though that was new with the deregulation. We have structures to finance in the oil and gas side, to finance reservoir development. So we're taking substantial risk there. But in CCS, I come back to the risk analysis, and it's very difficult to structure around some of the inherent risks of carbon capture with a non-recourse debt product. Some of those risks are not, you just can't structure around them. They are they're commercial risks or they're operating risks which you need to find some other solution for. I mean, we've in terms of commitment to the CCS industry, we did come up with a relatively innovative guarantee product to enable one of our plants to access some grant funding, and for a bank to provide a guarantee for essentially a startup company involved in carbon capture and storage on a development project with an uncertain future took some quite innovative structuring. That was a relatively small exposure. We're talking, if you look at the power plant plus carbon capture plant, we're talking of billions of dollars of equipment, and that's much more difficult to innovate around. So I think we can be innovative. We can sit down with clients, with governments, and push the boundaries of what we're prepared to do. Again, as we have done in solar, we have done in wind. But ultimately, there are still a number of risks out there which the lenders will never get comfortable with.
Okay. Maybe I can continue with a question from Sean McCoy, and he would like to know the following. The recent IEA industrial roadmap highlights the importance of industrial deployment in the near term, and refers in particular to gas processing. And it seems that these sorts of projects may pose less project-on-project risk, since often the same operator runs all three parts. So in your opinion, are these sorts of projects easier to finance by the financial community?
Potentially they are, and I think if you look through the report issued recently, you can see that a lot of the operating carbon capture plants are in fact related more to gas processing than power and other utilities. And I think the reason for that is that with a gas processing plant, CO2 capture is it can be part of the process of gas separation, and processing of those gases. The problem with the power industry and the added complexity of the power industry is you've got two completely unrelated industries. Effectively, you've got a chemical industry or a gas processing industry trying to link in with a commercially sensitive power generator who's got to operate his plant and sell his power into a real-time market. So you haven't got the same ability to deal with outages and problems with the CO2 plant that you may have in a gas separation plant. So the short answer is yes, but the issue still remains, dealing with the CO2, storing the CO2, and being compensated for doing that. But if the revenues from that side of it can be sorted out, then potentially they are easier to finance.
How do you see, and I now refer to a question from Michael Maloney, how do you see other industries, in particular steel and cement, and possible carbon capture plants in that industries to provide useful stepping stones to deploy CCS more widely?
Yeah, I believe that's so. If one project we're advising on, it had a number of emitters that, or it has a number of emitters that will ultimately feed into a common CO2 infrastructure. And quite clearly, if you want to start a CCS company like that quickly, taking CO2 from a gas industry or from a steel plant or another process plant which produces near it's a reasonably pure CO2 as a start or as an anchor supplier emitter is a good strategy, because as you move into the more market-based process plant and power plants, the complexity magnifies. But certainly in that project, that would be that is the exact strategy they're following. Start with, if you like, what you could call low-hanging fruit, although I'd still say there are commercial issues related to running a CCS plant off even or carbon capture on a steel plant, because steel plant still has the commercial rationale of selling steel, producing steel at lowest cost. So the commercial structure is still there, but it is an easier prospect.
Yeah, thank you very much for your answers, and also thank you to the audience for all the questions. We still have some questions here, but have run out of time, and we'll definitely speak to Allan with regards to the open questions. I would like to raise one final question to you, which is related to the way forward. Do you think it would make sense to bring together some banks in a symposium and bring it together with project proponents of those projects that are currently already under construction or operation, and facilitate a dialogue with a selection of banks on how financing could be moved forward, whether it's risk management that should be in the prime focus, or possibly parts of plans being financed to provide a first step, or whether it's just a approach to banks to also become possibly more responsible for climate change challenges and contribute their part to a broader deployment of CCS projects. Do you think that would make sense?
It certainly makes sense to give banks real-life examples of what's happening in the industry, because it's a way of convincing them that this is an industry that is developing, and there are real things out there. It's not just government policy. It's not just talking about plants. And we've set up a number of roundtables, for example, between the UK government, Department of Energy, and leading project finance banks. And they've been quite useful in identifying the core issues that the regulators, the government, the projects are going to need to face. So that kind of engagement with people who are actually out there doing it, breaking ground, putting money into the industry, I think would be very useful. It's a question of how that happens and coming up with the best forum for that to take place. Because I think lenders, banks, they may be perceived as being mercenary, but they are focused very heavily on climate change, on green energy, but that focus so far has been directed towards wind because it's established more recently towards solar, and to a certain extent towards nuclear in that it's low carbon. As I say, CCS is somewhat lagging behind that process just because of the stage that is relevant to the industry, I think. So having that kind of engagement, I think, would be very useful to show people there are actually things happening. There are plants being built. There are plants running.
Okay. Thank you very much also for that answer. Yeah, colleagues, thank you very much once again for your contributions and questions. Allan, thank you very much. And as said before, we will put a tape of this webinar on our website and inform you where you can download it. I would like now to conclude the webinar, and once more thank you very much, and wish you a very nice day, evening, or whatever time you are on. Thank you very much, and goodbye.